Hello there and welcome back to Capital Gains. We're thrilled to have you with us as we embark on an exciting journey through the world of investing. Whether you're a seasoned investor or just dipping your toes into the financial waters, you've come to the right place. Our channel is your reliable source for valuable insights, stock recommendations, and strategies to help you not only preserve but also grow your wealth. In this video, we promise you're going home with new and fresh information at hand. We're diving headfirst into the exhilarating realm of investments and everything finance. Buckle up because we're about to get to uncover the deep layers of the most controversial crisis of this generation, the real estate market crash. And what better way to understand it than hearing it from the highly esteemed investor of our time, Warren Buffett. Certainly, everything we do has consequences. I reckon we're starting to see the results of what billionaire investor Warren Buffett is warning about, a big problem heading for the US real estate market. This colossal $1.4 trillion debt-driven wave is already impacting the real estate market as we speak. But this is just the start of what Buffett believes are the outcomes of this real estate bubble. The real crunch is expected to hit in a few months. Here's what Buffett had to say when Tom Seymour asked about a recent Financial Times article. The article mentioned that Charlie Munger had raised concerns about a storm brewing in the US commercial property market, with American banks holding a lot of bad loans as property prices drop. Could you explain what's happening in commercial real estate? How bad are the losses going to be, and are there specific areas that look especially troubled? Another popular question is whether Berkshire would get more involved in commercial real estate as a result. Well, Berkshire hasn't been very active in commercial real estate before. It's more suited for individual investors dealing with taxes than for corporations, the way Berkshire operates. So I don't expect a significant impact on Berkshire, but I do think the transformation of downtown areas in the United States and around the world will be quite substantial and not very pleasant. I believe the country will manage to get through it, but it might involve different property owners, as they say. Over the past 15 years, the US real estate market has been boosted by a lot of easily accessible, low-cost loans. Look at this chart showing the US federal funds effective rate, which is like a measure of interest rates in the economy. You can see that for most of the past 15 years, interest rates were at a rock bottom 0%. These super low interest rates encouraged people to borrow a ton of money and drove property prices through the roof. Let's say someone is buying an office building in your town for a nice, even $1 million. Chances are, this buyer doesn't have $1 million just lying around in their bank account to buy the building outright. What they'll probably do is go to a bank and get a loan to cover most of the cost. In this case, our buyer is putting in $350,000 as a down payment, which they call equity. It's like when you buy a house. Then they go to a local bank to get a loan for the remaining $650,000. How good of a deal this is for the buyer depends on a bunch of things, but one of the most important is the interest rate on the loan. Let's say our buyer gets a loan with a 5% interest rate, where they only have to pay the interest each year. That means they'd have to hand over $32,500 in interest payments to the bank every year, sort of like a homeowner's mortgage payment. Whether the property can handle that debt payment depends on something called the property's net operating income. Basically, it's the rent the property makes, minus all the expenses for running and keeping up the property. In our example, let's say the office building brings in $60,000 a year for the owner. You can see that this property comfortably covers the debt payment. One important thing banks look at when deciding whether to lend on a property is the debt service coverage ratio, or DSCR for short. Think of it as a measure of how much room the property has to make its debt payment if things take a bad turn. It's calculated by taking the property's income, in our case $60,000, and dividing it by the annual debt payment, which is $32,500 in our example. That gives us a DSCR of 1.85 times. As a general rule, banks like to see a DSCR greater than 1.2 times, especially at a 5% interest rate and with a net operating income of $60,000. This property passes that test with flying colors. So, thanks to the low interest rate, our buyer here is making a good profit even though they borrowed most of the money from the bank. Okay, when interest rates go up, it's a problem for commercial property owners. Unlike home buyers with fixed rate mortgages, commercial property loans get adjusted every few years. If the interest rate goes from 5% to 7%, the annual debt payment on a $1 million building jumps from $32,500 to $45,500. If it goes to 9%, that payment is $58,500. If the building's income drops, say from $60,000 to $40,000 because of reduced demand for office space, the owner's in trouble. The income won't cover the debt, and the property might be foreclosed. The bank sells it for less, and the bank takes the loss. Buffett explains the real estate situation as follows. In real estate, many opt for non-recourse loans, where they're not personally liable. Successful real estate professionals often gauge a building's value by what they can borrow without personal guarantees. This approach leaves lenders essentially owning the property but unwilling to hold it. Real estate operators negotiate with banks, leading to various large-scale commercial real estate developments. However, this has consequences. When you borrow to buy a home, you must provide a personal guarantee, making you responsible for repaying the loan, regardless of the property's value. If the house's value drops, you can't simply return the keys to the bank and walk away. The personal guarantee binds you to cover any shortfall, potentially leading to bankruptcy. You'd think things would work similarly for commercial real estate with personal guarantees, but they often don't. Instead, this is how it works. Large commercial properties like office buildings, apartment complexes, and warehouses are often bought with non-recourse debt. Here's the deal. Let's say a big real estate investment firm purchases a property for $50 million. They put in $10 million of their own money and borrow the remaining $40 million from a bank through non-recourse debt. Fast forward a few years, and it's time to reset the interest rate. Unfortunately, the property is now worth only $30 million because it was bought when real estate values were high and interest rates were low. Since it's a non-recourse loan, the property owner can give the keys back to the bank and walk away. They lose their $10 million, but the bank is left with a property worth less than the loan. With non-recourse loans, the bank has no choice but to absorb the loss. This isn't hypothetical. An estimated $1.4 trillion in loans are due soon. Many of these properties are worth less than their purchase price and can't handle higher interest rates, leading to foreclosures. We're already witnessing this as Starwood, a major real estate firm, defaulted on a $212 million loan for an Atlanta office building. The property's value significantly dropped, forcing Starwood to hand it over to the lender. These defaults will have long-lasting effects, particularly on small regional and community banks, which made most of these loans. These banks also play a vital role in lending to small and medium-sized businesses, so while they may sustain losses, they are unlikely to significantly reduce their lending. This will negatively impact small and medium-sized businesses' access to credit, hindering their growth and hiring potential, ultimately affecting economic growth. The outcome in the real estate market remains uncertain, but there will undoubtedly be substantial repercussions, as Charlie Munger predicted. The question is, who will suffer the most? That wraps up our video on Warren Buffett's insights on the current real estate crisis. We're curious to hear your thoughts, so please let us know in the comments below. As always, remember that before committing your hard-earned money to stocks or investments, thorough research and analysis are essential. Show your support by liking this video and subscribing to our channel for weekly updates on the best cutting-edge investment strategies for building wealth. Thanks for tuning in to Capital Gains, and happy investing.